Good morning. This is Carl Grund, and welcome everybody to Coffee with Carl. This morning, I have the distinct pleasure to welcome Jonathan Bauman from American Century. He is a portfolio manager in the growth space. And Jonathan, welcome.
Thanks, Carl. Happy to be here.
Perfect. Thanks again. So this morning, spent some time with Jonathan here talking about the overall markets, what American Century is seeing, where they see some of the opportunities are, and where we go from here. So why don't we go ahead and get started? Jonathan, with yours and American Century's view, what is the outlook for the U.S. markets, maybe in the near term and into 2021?
Yeah, it's a good question, and obviously a lot of things going on that I think can influence that outlook, and maybe focus my comments on kind of what I'm thinking as the three V's. The first being sort of this V-shaped recovery we've seen in the equity markets so far this year, and really the strength that we've seen coming out of the March downturn. The second being the virus, and increasingly in the U.S., we hit a record level of deaths, unfortunately, yesterday, and obviously very strong growth in cases more recently. And then the third being the vaccine, which is something that we've gotten a lot of very good, I think better than expected news on in the month of November. The FDA is meeting today, in fact, on Pfizer's vaccine, and hopefully we get some emergency use approval there that can start getting the frontline workers and those most at risk vaccinated in the near term. And I think all three of those things have really kind of played together this year, right? Yep. I think as we've gotten more optimism around the vaccine, that's helped drive the further of the V-shaped recovery. That being said, I do believe that in the near term, at least, we've probably pulled forward or discounted, if you will, a lot of the really good news, right? The market at this point expects that we're going to get back to the level of economic growth probably in the back half of next year as we get everyone vaccinated. But I think there's the potential for, in the near term at least, a bit of an air pocket where some of that great news, maybe we realize isn't maybe as great as we thought, right? There's a lot of logistical issues that we'll have to work through in order to really get to that stage in the second half of next year that I think could create some choppiness in the near term, and ultimately some digestion, if you will, of a lot of the good news that the market's already baked in. But longer term, I think ultimately we get back to some sense of normal and the economy recovers. And I think, looking further out, even beyond next year, I think it's where we're set up nicely for a strong improvement from where we are today.
When you talk, I guess, near term, right, and you talk about the air pockets, I think there's a lot of assumption that we will have, obviously the vaccines had very high effectiveness, and they'll be able to distribute them. Are you guys basing, on your due diligence, what's your base case for that? Do you expect that we will be pretty successful, or are you guys baking in some issues? And when do you guys see maybe the general economy getting back to normal, which will, how that affects the ultimate stock market as we kind of go into 2020, 2021?
Yeah, all great questions. I think our base case is that the market already is discounting a, mid-year 2021 resumption, maybe not all the way back to where we were in 2019, but getting back to where, the majority of the population has been vaccinated, and you can get some resurgence or recovery, if you will, in the economy. And I think that's what the market's discounting. And in fact, we've been repositioning our portfolios over the last couple months, moving some money away from those areas of the market that have been beneficiaries of the stay-at-home orders, Zoom, for example, right, as a great example, where we're conducting this interview today, towards those companies that, may benefit from that inevitable recovery. So areas related to travel, areas related to concerts, so like Live Nation would be an example that we just recently talked about, because ultimately there's pent-up demand, right? People haven't been on trips. As soon as that green light comes out and people feel confident doing that, good luck booking a vacation, right? It's going to be crazy, right? Everybody's going to be trying to get out at the same time. So we do think there's that positive coming. And I think the market is already discounting a lot of that good news in. So our fear is, there's a lot of logistical challenges with getting this vaccine out to folks. A, getting folks comfortable taking it. B, getting it distributed. If as many of you know, the two vaccines that we've gotten good news on have to be stored at very cold temperatures. And so how do you get that distributed to the end point where you can actually administer the vaccine? You've got states like Wisconsin basically making decisions over, do they use their dry ice to freeze cheese curds or to freeze vaccines, right? I mean, so you've had like this increase in demand for dry ice and all the logistical things that go into the vaccine, not just from the vaccine, but also from people shipping food and things as well in this pandemic. So, I do believe that there could be some hiccups along the way, right? We'll ultimately get there, but the timing of when we get that sort of green light, if you will, may slip, right? I think, the U.S. currently is, expected to get 100 million doses of Pfizer's vaccine. That's enough to vaccinate 50 million people because you have to take 2 vaccines. But then there's this cliff, if you will, after that, where we really aren't signed up for any more until mid next year, right? And so I think there could be some noise along the way, especially if we continue to see the spread of the virus without the vaccine, through this winter, continue on the pace we've been on, candidly. And I think all those things to us, again, while we've shifted and we've become a little bit more balanced in our positioning, we still think there's potential for some choppiness, if you will. But ultimately, we'll get there. It's just that timing may slip.
Do you think in the near term, as you have some investors maybe saying, hey, should I get in the market? Should I wait? How do you think the stimulus plays into that? If we don't get any further fiscal stimulus, I know we're going back and forth and there's bills being put in front of every single day. Are you guys' expectation that we may get something, or this could get pushed again into 2021 on that end? And what would be the effects on the market?
Yeah, I think the market's already factoring in some element of stimulus. The consensus seems to be right around 900 million or billion, sorry. And ultimately, there's debate as to both sides trying to get different provisions, but I think everybody's comfortable with the dollar amount. So I think ultimately something will happen. If it's not before the end of the year, likely under the Biden administration in January, we'll get there. So I think the market's factored that in, and I think it's needed. And candidly, it's been needed for a few months. It's sort of like it's been obvious you have a sick patient, and all the doctors are standing in the room trying to. They all know that the patient needs some sort of medicine, but they can't figure out, which dosage is the right amount. But ultimately, I think we'll get there. And I do think it is needed because there definitely are parts of the economy that are really, really struggling, and individuals that are really struggling. And I think it can help bridge that gap until we can get some resumption of normal economic activity. So we believe that is definitely going to happen. But the more noise you have around it can create some volatility for sure. And we've seen that more recently.
When we talk about continuing the rally, obviously there's a lot of potential for opportunities, right? And the broadening out of the market. Where do you think the best areas would be in overall U.S. markets to really go out and invest in? And then are there any catalysts that you guys see that would take us from call it 3,600 to 39 to 4,200 on the S&P? What are what things are you guys keying in on?
Yeah, so again, we're bottom-up managers, so we don't set a top-down call on the market. But what we're seeing and what we hear from companies is that things have actually improved quicker than I think most companies thought, right? And so in certain pockets, whether that's technology, whether that's areas of healthcare, the underlying results are really quite strong, and companies are feeling much better about things today than they were 3 months ago, 6 months ago. The challenge is the valuation of those companies has also improved pretty dramatically. Right. Yeah. And so the market sort of sniffed that out. So I'd say over longer periods of time, we're still, I think if you think about, kind of splitting the market into more growth oriented areas that historically have benefited in environments where maybe economic growth is slower and people are willing to buy those companies that can kind of make their own way and benefit from some sort of secular trend, right? Whether that's increasingly people shopping online or increasingly people working from home. These are all things that we think the pandemic has accelerated, but aren't going to go back to where they were when everything gets back to normal. So we think longer term, those more technology-oriented, innovative companies will still benefit and likely should still have a pretty heavy weight in individuals' portfolios. On the flip side, though, I think if we do see a very strong acceleration in the economy, if under a Biden administration, there's increasingly a focus on higher infrastructure spending, areas of the economy that have really kind of been left in the dust so far this year. I think your more cyclical areas, your industrials, your energy, materials, financials. We think those areas can actually make up some ground, right? And so at least in the near term, that rotation, we're already starting to see some signs of that, could benefit those more value-oriented areas of the market that have really lagged pretty substantially this year. So I'd say, as an investor, I always believe balance makes a lot of sense. Trying to time these things is really hard. And as you and I have already talked about on this call, there's so many moving pieces and so many things that can go wrong that none of us have perfect foresight. But I do think, if you're shading your portfolios, within your equity allocations, it's likely that over the last year, you've gotten probably a little heavier in large cap growth than maybe you would feel comfortable with, just because that's where the market's gone and that's what's increased in weight in your portfolio. So I'd say, skimming some of that off, maybe a little bit more to the value side, a little more to the core side, and actually a little bit more down cap as well. Mid caps and small caps, tend to do well when the economy is recovering, and we do see that, again, as we look out to next year.
Mm-hmm. Yeah, I guess when we talk about the big tech space, do you guys have some concerns? You hear Facebook, there's a bunch of litigation coming against them. Do you have some concerns in that space for continued growth?
I'd say our concerns are not growth oriented as much as they are valuation oriented. Yeah. The interesting thing with Facebook is, and you point to the fact that I think it's 46 states and Guam and Puerto Rico, so basically 48 entities have signed on to file a lawsuit against them, and we really essentially want to break the company up, right? So Facebook acquired Instagram, they acquired WhatsApp, and they rolled into this massive conglomerate, and the argument is that just stifle competition. We talk about this quite a bit in our team meetings, and we think ultimately it's probably not going to lead to a breakup anytime soon, and B, Facebook still has the best model for advertisers to advertise, right? Mm-hmm. If you look at what's happened in the media space, newspapers obviously are not growing. Television is not growing, right? People have shifted their viewing habits, they've shifted their entertainment habits. And so for companies to advertise, Facebook's got the best mousetrap, right? So we don't see that impacting their growth necessarily because there's really no other alternative, but that's kind of the whole problem, right? That the DOD, that people are looking at is like, there are not as many good alternatives in social. We've been breaking these guys up. So, we do think that's a potential cloud, if you will, on the valuation of Facebook. There's some concerns at Google as well, and a lot of these large tech companies that they've gotten just too influential. And so I think that could be a risk to the valuation multiples of those companies. But if you look at their underlying fundamentals in terms of their business models, they're right perfectly aligned with where things have been going over the last decade. But probably, again, what's gotten accelerated by the pandemic and allowing them to continue to grow moving forward as well.
And then you mentioned energy briefly. I know with the Biden administration, right, where there's going to be certainly a push to be more clean energy. How does that administration, or how does it look under that administration when we talk about, the big companies like Exxon, Chevron? I know Chevron recently put out a piece that they're going to work to improve on their end, but, what are your expectations, and, how do you guys invest? Would you guys go about investing in that space?
Yeah, no, my view is probably going to be different from what you might hear from a value manager, just because in the growth area of the market where we manage money, energy is essentially non-existent. It's very, very small weight in our benchmark or non-existent. Yeah. But something still we want to think about. And I think, if we haven't hit peak oil demand yet, we're probably getting pretty close to there, right? I think as you're seeing increasingly, cars are more fuel efficient. People are shifting technology to more battery or at least hybrid vehicles. People aren't driving as much clearly in the pandemic, but there's debate. Will there be as many telecommuters even once we go back to normal, right? Will more people work from home? And, I don't know about you, but, in this last 6 months, I've probably, put more gas in my lawnmower over the summer than I did in my car, right? Like, now, obviously that's not going to be persistent, but ultimately that demand for gasoline is just likely not going to be what it was. And I think energy companies are recognizing that, and those that have recognized are already transitioning and will transition into other forms of renewable energy and ways to provide the different types of energy that people want. And so, I think they will adapt. That being said, I don't think oil demand is going to go away completely, right? This is going to be a long-term transition that just can't happen overnight. You think how many hundreds of thousands of gas stations there are in this country, there's not anywhere close to that in terms of charging stations, right? So you're just not going to instantly get away from the internal combustion engine and go to electric vehicles. But as you think of it as sort of a mountain, right? We've kind of maybe gotten closer to the top of that mountain. It's sort of a slow decline in terms of energy demand going forward. That being said, energy is by definition a cyclical, right? It's very dependent upon the economy, and it's been depressed this year because of a weaker economy, and it'll be accelerated if we get a real strong bounce back in the economy. So I think having exposure there does make sense if you're just purely viewing it from a cyclical standpoint.
Okay. And if in the industrial space, you named that one out. Any companies you guys really love right now?
Yeah, the areas of industrial that we really like most, I'd say, are those that are kind of almost have a technology component to them. So I think a company like Rockwell Automation, right, that helps manufacturers and distribution centers be more efficient. Ultimately, it's not necessarily good for the sort of employment picture, but ultimately it allows you to have fewer people working closely together on these assembly lines and allowing automation to take some of that risk away, if you will. And I think companies are recognizing that if they can be more efficient in terms of their manufacturing and have less density, if you will, in the manufacturing process, that maybe makes sense coming out of this environment. And so I'd say more of that technology-oriented exposure in industrials makes sense to us. And then there's some auto exposure that sort of fits into the industrial space as well, like a company like Autoliv, a company like Adaptive Technology, where to the point I made earlier, not only just electric vehicles, but if you just think of the technology in your internal combustion engine vehicle and all the active safety and cameras and sensors, we think those areas will continue to benefit from those secular trends as well.
Yeah, they had, I guess this week, a guy who had a sensor company. They were going to go public. It was a younger gentleman, just became a billionaire over it. So you can certainly see some of the growth opportunities there. I guess one of the questions I would have too, I mean, not an issue now, but with the amount of money that we flooded into the economy, what are your guys' expectations for inflation? And then how do you really parlay that into your analysis with some of these companies as we move forward?
Yeah, I mean, I think, inflation is something we haven't seen for a while, right? And we've been in a very low interest rate environment. And obviously, inflation can be a good thing in terms of getting the economy restarted, but too much inflation, that definitely can be a challenge for savers. And we're seeing that now, right? If you look at your return on cash, it's a negative real return, meaning you're basically losing to even the little bit of inflation we have because you're earning absolutely nothing in interest. And I think it's part of what's driven the rally we've seen in stocks too, right? People saying, well, there's really no other alternative to get some growth, and so I'm going to put it in the equity markets. And so I think if you see inflation bubble up, which the Fed is almost encouraging with what they're doing, I think equities will continue to be a pretty good hedge relative to that. And for us, it's just a question of, are a company's cost of sales and the cost of the materials they need to make their product rising at a faster pace than what they can turn around and sell those products to the end consumer at, right? That's for us, as we think of evaluating companies, the biggest risk, because margins have actually held up pretty well through this downturn. Companies have been able to adjust their cost structures pretty quickly to adapt to slower revenues. And so that's allowed them to keep earnings growth, better than it would have been, otherwise in this slower economic environment. The challenge is if your input costs start to rise much more dramatically and you're not able to pass those costs on to the end consumer, that to us is more of a concern than for earnings growth, which can lead to weaker equities going forward. But yeah, at this point, we don't see any concerns. I know the inflation numbers came out this morning. They were slightly warmer than people thought, but still nowhere near hot by any stretch of the imagination. But I think, candidly, that's really what we're hoping to see is a little bit of just a pickup in higher prices that can lead to ultimately better growth for some of these companies if we can get the economy going back again.
No, that's really helpful. I guess we look at the outlook in bringing it full circle and maybe in the international side of the house. Where is there any areas that you guys like over there in particular?
Yeah, I mean, I think that emerging markets have been interesting this year. They've been actually been, I think, quite a bit stronger than people would expect, and I think part of that's been the timing of, they tended to lock down their economies earlier than we did in the U.S. Right? They were hit hardest by the virus earlier on. They did a pretty good job of sort of, I wouldn't say completely eliminating it, but getting it to a point where they were able to reopen their economies and keep them open. And so you've seen that benefit, areas like China and other emerging markets. And we think that that can continue. Again, if you get the economy resuming some growth in the U.S., a lot of what drives that economy is products and services that are produced outside of the U.S. and in the emerging markets. So we think emerging market space is still an interesting area, but we have seen a pretty nice rally there. I think other developed non-U.S. markets are also looking a little bit more interesting, and part of this will come back to the comment I made earlier. The U.S. market's pretty tech healthcare heavy, right? But if you look at parts of Europe and other parts of the world, they tend to have more of that industrials, energy, materials, more of that cyclical type exposure. So if this is a sort of coordinated global economic recovery that we see, I think just by the types of companies that you have exposure to in the U.S. versus non-U.S. markets, you could see some of those non-U.S. markets actually do a little bit better than the U.S., at least in the near term. Again, my long-term view is innovation wins, and if we're going to kind of have this muddling on economy once we get past a sharp recovery, tech, healthcare, those more innovative areas likely are going to be where you want to be, and that does probably favor the U.S. But I do think near term, kind of in conjunction with the comments I made earlier, areas outside the U.S., because of the types of companies and exposure that they have, are set up nicely to benefit from that economic recovery.
Well, if you talk about innovation, I guess my question would be, and internationally, obviously China has a number of very large conglomerate tech companies as well, and as they continue to innovate, how do you see that relationship with the U.S.? I mean, there's been conversation about blacklisting them from our exchanges. So how do you see the innovation playing out between the two of us then?
Yeah, I think it's a great question, and it's always been this sort of interesting dance that we've had to do with China around. Obviously, it's a huge market. Most of the technology products that we all use, you look at your iPhone, for example, it's made in China, right? It's designed in the U.S., but made in China. We've had to have those relationships in order to make that possible. The biggest concern with China has always been around intellectual property, and how do we protect U.S. companies from that intellectual property being stolen? And I think that's going to continue to be a concern. But it's also, most U.S. companies recognize that it's a huge market. So not only do we want to be able to sell products to China, or rely on China to help in manufacturing many of those products, but we also recognize that they can essentially take many of our very successful products and replicate them if we're not able to protect our IP. So it's going to be interesting to see. Obviously, the Trump administration took a pretty hard line on China, and obviously a lot of the tariffs were put in place to help level the playing field in their perspective. I think there's been a lot of talk around protecting IP. I think the Biden administration is going to continue a lot of those things, candidly. I don't think we're going to see a huge departure there, because I think there's this recognition that protecting intellectual property is an important component. But I think China's going to continue to be a large market for a lot of U.S. companies, whether it's technology companies or the Procter and Gamble's of the world. You're still going to have that as a very large market that U.S. companies will benefit by having exposure to.
That makes perfect sense. So internationally, I guess the takeaway there is you guys really like the emerging market space for the opportunity for growth. In the U.S. space, you mentioned mid-cap, and in particular, performance-wise, there's been a lag, I guess, when I look specifically at the small cap space. If we were to look over the next 3 years, do you think maybe the mid and small will outperform finally the U.S. and generate that risk premium, or do you think we'll still be lagging a lot of these large companies?
Yeah, it's a great question. We've already seen quite a bit of a move just in the last few months. In fact, November was the strongest month ever for small cap stocks if you're looking at the indices, and that's pretty typical actually of these inflection points in the economy, right? People, if they say, hey, things are looking great, give me as much leverage, if you will, to that greatness. And small caps and mid caps historically have given you that exposure. The challenge has been historically sustaining that over a long period of time, right? I think that makes sense as part of your portfolio, but ultimately either outperformance versus large tends to be more episodic, especially if you look at it on a risk-adjusted basis. So I'm not going to say that we've already seen the move and, don't forget small caps from here on out, because I think there's still going to be periods, especially if we get surprised to the upside on the strength of the economic recovery. I think small caps and mid caps actually can do better than large. And I think a lot of the outperformance we've seen in large, just a little bit leaving Apple stock, for example, can fund a lot of purchases down cap, right? And so just a little bit of shift can have a really big impact. But I'd say a space that often gets overlooked that we always have really shown to be what we'll call the sweet spot of the market really is mid caps. If you look back over time, long periods of time, generally speaking, you're getting a better risk-adjusted return than small caps, and in many cases even large caps with those mid-cap stocks. And it makes sense, right? They're the companies that have graduated from small cap land. They've got proven business models, well-established management teams, but they still got a long runway of growth ahead of them, right? They haven't gone to that large cap where it just gets harder and harder to just bump up against the wall of large numbers, right? So I'd say that would be a space that maybe people are underexposed to in their portfolios. That maybe you don't have as much volatility with small cap. You're going to benefit if the economy recovers. But if large caps do continue to lead, the mid caps tend to stay along for the ride a little better than small caps do. So that'd be my sort of perspective.
Any big recent winners that you guys have had a lot of success with in the mid cap space when you guys are looking from the bottom up?
Yeah, I'd say some of these are going to be unfortunately kind of obvious, but anything that's benefited from the transition in consumer habits, right? So think of a name like Peloton, for example, has been a big contributor for us in the mid cap space. Another company called Twilio, which is a technology company. So if you've ever taken an Uber and you press the button to talk to your Uber driver, that person doesn't know your number, you don't know their number, they basically connect the two ends on the back end. They're seeing very strong growth, not because people are taking Uber rides, but obviously that technology is applicable to lots of other online platforms. But that being said, those are areas that we're looking to say, okay, we've seen a pretty strong move, they've benefited from this. Peloton, I think, has created a nice network effect and picked up a lot of users of their product, whether they bought the bike or they're just using their online app or what have you. And I think they'll probably keep a lot of those, but are they going to see the same type of growth next year and the year after that they saw this year? Probably not, right? And there's increasing competition coming. Apple's launching their Fitness Plus app here in 4 days. And so those are things that, have us a little more concerned about that name, but it's definitely been one that's helped us so far this year.
And then last question. I know, so we've seen some pretty big winners in the last few weeks when you look up by like QS and some of these EV companies, and these companies are really fueled by these SPAC groups. How do you guys, think about some of these smaller companies that kind of come out of nowhere and then, are really funded? Do you guys just totally ignore them? Or, how do you deal with them? Because some of them, you look at it and these vehicles are really driving these 10, 20, 40, 50% gains, really short term. So how do you guys think about, for example, like Virgin Galactica, right? They're funded by a SPAC as well. So, what are your thoughts when it comes to some of those companies?
Yeah, I mean, I think we tend to treat them like any other company, right? We want to understand, ultimately what's getting better. Do we think that's sustainable? Is the valuation make sense? I think a lot of those companies have benefited from an environment where there's just been sort of this hunger for just give me as much, sort of potential upside opportunity as possible, right? And whether that's been through these SPACs or whether it's just been in the IPO market. I mean, look at DoorDash yesterday, right? And basically doubled, right, in its IPO. I think it kind of smells like an environment where people are just looking for anything that's almost, I don't want to call it speculation, but that's sort of what it is, right? Like people basically invest because they think it's going to be worth more the next day and the next day and the next day, but the underlying business fundamentals, you can question, like, do they actually make sense from a valuation standpoint? So we haven't really participated in any of those SPACs, not to say that if they prove to be real companies with, high quality earnings and margins, that is something that we wouldn't be interested in down the road. And we do participate in IPOs from time to time. Again, if we can get a good understanding, the benefit of the IPO for us is we have all the disclosure requirements that come with an IPO. We typically are meeting with company management before the company goes public. In the case of Airbnb, we're meeting with them for 2 or 3 years, right? So we know those companies pretty well. These SPACs sort of come from nowhere. They don't have the same regulatory requirements in their filings. So we tend to kind of view them with a little bit more speculation, I'd say, until they're public for a couple quarters and we get a sense of what the true business fundamentals look like.
And I'll turn it over to you. Is there any, I guess, when it comes to special sauce, anything that you want to highlight for American Century that you guys really specialize in, for some of the viewers when they're taking a look at different funds?
Yeah, it's a great question. Again, my view is going to be biased because I'm in the U.S. growth discipline. And, we've been in the U.S. growth business for over 60 years. That's really what started our company. And what's always set us apart from a lot of traditional growth managers is the focus that we have on business improvement. So for us, it's not so much about a company growing at a certain threshold level, right? We want to see 15% growth or we're not interested. It's more about the improvement and do we think that improvement's sustainable? So we may invest in a company that has very low absolute growth, but it used to be negative, right? And so that inflection is really what we're looking for. And ultimately what sets us apart from a lot of other growth managers. And again, something we've been doing for over 6 decades.
Oh, that's awesome. And, I want to go ahead and, thank you for your comments today. It was really, really helpful. I'm sure my viewers will enjoy it as well. So go ahead and finish up today. So thank you, Jonathan, and certainly look forward to chatting with you again in the future.
You bet. Thanks, Carl. Appreciate the time.
Take care now. Bye.